Hello, this is Brian Rezny, President of Rezny Wealth Management. We've got a great show for you today. We're going to take your questions, of course, and we're going to discuss a lot about investing in the markets and the economy, how you can increase your retirement income. Of course, visit our website, reznywealth.com. You can also send me email questions that I can answer on the TV or my radio show on Sundays at brianrezny@reznywealth.com. Visit our website, though, where you can sign up for great information and some great free reports. One of our top reports is How to Avoid Outliving Your Money During Retirement. It's a groundbreaking report. It talks about some of the investment pitfalls that a lot of retirees make and how you can avoid these pitfalls so you can profit, and ways you can increase retirement income and protect your portfolio from catastrophic loss. You know, it's interesting. I look at the markets, I look at the economy. Of course, we're in the fourth quarter of 2014, and things are off to a really good year. And ultimately, we've seen some volatility. That volatility has scared a number of investors. We get calls repeatedly, not only on my TV and radio shows, but also into our office. Investors who are concerned about their money. How should they be managing their money? Are they taking too much risk? How do you increase retirement income? We're going to cover some of those topics today, and we're going to make sure that you can make better decisions around your portfolio without the conflicts of Wall Street, banks, and insurance companies whose job really is just to sell you inferior investments that's not in your legal best interest. Why you need an adaptive investment strategy to grow and protect your retirement portfolio. This is really groundbreaking information. So many investors have been lulled into really, I believe, a false sense of security by their Wall Street firm, the bank, or the person selling annuities, that you just kind of plop your money into certain investments and you let it ride. Well, folks, I'm here to tell you that your retirement and your portfolio is not Vegas. You don't want to let it ride on black or red. You want to make sure you're doing the right things with your portfolio. There's times where you do not want to own equities or stocks. There's times you want to reduce exposure to long-term bonds. There's times you may want to own some gold in your portfolio. There's times you want to hold significant amounts of cash, like in 2000 recession and 2008. Too many investors were told by their Wall Street firms, hold on, things will come back. How did that work out for your portfolio? Unfortunately, that's not adaptive. Buy and hold says, I'm going to own a bunch of stock mutual funds or stocks or bonds, regardless of market conditions. That's a mistake. Large drawdowns happen in equity prices in a recession, and if you buy and hold investments that are not right for today's economic climate, you could lose big in your retirement. Buy and hold, set it and forget it mentality. It hasn't worked in over 14 years. In 2000 alone, the equity markets dropped over 50%. How did your portfolio fare? In 2008, equity markets again dropped over 50%. How did you do? Did you sell at the bottom? Did you ride the roller coaster all the way down? Or did you adapt, meaning as the recessionary indicators were coming about, and the market started to crest and come down and slightly become relatively weak, did you start selling for the right reasons and raise cash? That's important, especially if you are 65, 70, or 80. You have a long-term retirement. You want to make sure you can protect against major catastrophic downward falls in equity prices, not these 2 and 5% bounces in the road we see every single day and every year in the equity markets. But remember, recessions typically cause equity prices to drop 30 to 50%. How are you going to adapt your portfolio when the next recession comes? Recessions hurt. 2000, again, markets dropped 50%. How did you do? In 2008, equity markets again dropped 50%. How did your portfolio fare? Did you buy and hold? Did you listen to that advice on hold on, things will come back? Again, hasn't worked in over 14 years. Too many investors, again, do not have a sell strategy. Most investors hold assets because they believe their Wall Street firm or their advisor, who's really acting in a broker capacity, is actually watching and managing your money. Remember, there's two standards. There's a fiduciary standard under a registered investment advisor money manager capacity. There's a suitability standard. Suitability is what most of these advisors, banks, Wall Street, and insurance companies work under. Suitability, and if you have a brokerage account, you're really on your own. So when the next recession comes, don't expect a call from your advisor, your so-called vice president, because you have a brokerage account. A managed account under a registered investment advisor is much different than a brokerage account. In a brokerage account, you're on your own, and don't expect Mr. Warm and Fuzzy personality to call you to tell you it's time to sell. His job or her job is to sell you investments those firms represent and manufacture. Watch for these slowdowns in the U.S. economy for the next recession. Now, I will tell you this, we're not seeing slowdowns in the recession, and if I look at our crystal ball, which is pretty clear 12 months out, and we update that on a daily basis, things look pretty good in the U.S. economy. Of course, other economies aren't doing quite well, but these are things you want to look for in order to, when you should actually sell equities and reduce risk and protect your retirement. Slowing GDP or gross domestic product, rising unemployment. Unemployment is going up, not down. Falling corporate earnings. Remember, corporate earnings start to roll over and go down. That will usually drag stock prices down, meaning GDP is slowing down, and we're usually entering a recession. Fast rising interest rates. We're not in that environment now, but over time, if the economy is stable and we see the Feds maybe overreact, rates may go up too fast and slow the economy and put us in a recession. Also, elevated inflation. Inflation's running about 2 to 3% right now in the U.S., not elevated. When you see elevated inflation, usually above 4%, that usually tells you that the Fed starts raising rates, and that usually tells you that it's going to slow the economy and usually leads to a recession. Watch those 5 indicators. They are very helpful in determining when to sell versus your emotions on bailing at the wrong time and losing either potential further returns or selling at the bottom. Remember, a sell strategy is more important than ever. Don't expect your broker, Wall Street, or your bank or insurance agent to call you to tell you to sell, because you probably have a brokerage account, which is not a managed investment advisory account. There's a big difference. If you want to learn more about fiduciary versus suitability, go to my website, reznywealth.com. You can download for free our groundbreaking report. Your number one investment in retirement risk is fiduciary versus suitability. Not understanding that your advisor may just be a salesman in a suit, or do you have a real money manager who's working in your legal best interest? Go to reznywealth.com right now and download that free report. I'm going to go to my first question. And if you have a question about your portfolio, you can send it to Brian Rezny at reznywealth.com. You can also visit our website, reznywealth.com, and send us an email question through that site, and we can answer your question on our next TV show. Steve in Naples, Florida. I am 68 and still working full-time. My current investment breakdown is 55% stocks, 35% bonds, and 10% cash. I want growth. What are your thoughts on my allocation? Steve, great question. This is what I would tell you. You're still working, and it sounds like you don't need income from your portfolio, but you want to grow your portfolio. The misnomer that too many investors have is this. They typically over-allocate to cash and bonds at exactly the wrong time. Interest rates are extremely low. I firmly believe if you're trying to grow your portfolio, you need a little bit more equity exposure, high dividend paying. I would look at large cap in the U.S. primarily right now, because we are in relatively stronger territory on the large cap side. Mid cap is followed second and third by the small cap market. Now, I will tell you this, we prefer small caps longer term. In our opinion, it's going to give you the bump and extra return you're looking for. But about 20% of the time, small caps underperform large cap. So far in 2014, we've seen that lagging of the small cap. What does that tell me? It tells me there's a great opportunity and chance that probably in 2015 you want to up your allocation to small cap, because there's a chance for another year of outperformance. Again, no guarantee to the future, but I can tell you if you look at 3, 5, 10, 15, 20-year time frames, small caps and then followed by mid cap, you often beat the large cap stocks by a country mile. Having small cap allocation in your portfolio and upping that with your cash money might be exactly what your portfolio needs. Todd in Cape Coral, Florida. I am 65, retiring now. I'm concerned about long-term retirement. How long would you plan on life expectancy, and what is the number one retirement mistake you see retirees make? Todd, great question. First off, on life expectancy, if you're 65 and you are married, there is about a 90% chance you or your wife, one of you, will live into your 90s. I can tell you, I've been managing money for 28 years. I have clients that are well in their 90s. I have some approaching 100. People are living longer lifespans. If you're 65 years of age, you should plan on at least a 25 to potentially a 30-year-long retirement. If you have longevity in your family, then it's important that you make sure you plan appropriately. Do a retirement projection. Every one of the clients at my firm, every single year, and every time we take on a new client, we do a detailed retirement analysis to show them how to maximize Social Security, how to maximize pension and lump sum distributions, how to minimize taxes, and how to maximize portfolio growth and maximize retirement income. The biggest mistake retirees make is not having a plan and believing falsely that all investment firms and advisors are actually managing your money and legally working in your best interest. When the sad fact, 90% of these firms are sales organizations selling the product they're required to sell, and then they don't do any planning around your retirement. They don't know how to maximize your Social Security, pensions, or lump sums, and they certainly don't know how to maximize your retirement income. It's important that you hire the right firm to help you manage your portfolio, not only for growth and income, but for risk protection when the next recession comes. If you're managing your own money, spend a lot of time and expect to spend a lot of time throughout retirement, because once you start investing, the process never ends, neither does the research, if you want to be a successful investor and you want to build and grow a successful retirement portfolio. Too often investors, again, set it and forget it, by a group of mutual funds, are sold the annuity of the month by Mr. Annuity Salesman, who again is not working in your legal best interest. They lock their money up for prolonged periods of time with no liquidity, and after 2 or 3 years of realizing the performance stinks and you're not making your goals, you can't get out of these products because of huge surrender penalties. Make sure you understand what you're getting yourself into before you do, so this way your retirement can be as profitable as possible. Andy in Fort Myers, Florida. I panicked and sold out last month with my retirement portfolio. I thought things were headed for a large correction in the stock market. How does one get back in now? Andy, I think that's another excellent question. Let me tell you, I've been, again, managing money for 28 years. I've seen a lot of corrections. I saw 2000, I saw 2008, I saw 1987 when we had that 30% drop in about 2 days. I've seen a lot of corrections, and I've also witnessed a lot of investor mistakes. I repeatedly am called, not only on my TV and radio show, with questions about emotions. Emotions are going to get you in trouble. If you're an investor and you're emotional, or maybe you can't make the decision to buy or sell something because you just don't have maybe the knowledge or the discipline, find a real money management firm, a fee-only fiduciary firm, to help manage your money. Because what's going to happen is this. You sold when you thought things were going to get bad, because you thought. Thinking and your thought patterns, which really lead to bad emotional decisions, is not a great way to plan your portfolio. Too many investors, and I could tell you this because we received literally hundreds of these calls back in 2008 and 9, investors who panicked and sold at the bottom. Remember, you want to buy low and you want to sell high. You're never going to buy at the bottom. You're never going to sell at the top. You just want to escape that 30 or 40% decline in the middle. Too many investors base emotion. So think about this. As an investor, you basically sold. Markets rallied 10, 12%. You missed out on that. Now you're going to get back in, and what if we have another mini pullback of 2 or 5%? Are you going to get out again? You need help. Investors need somebody to guide them in order to help their portfolio so you don't make bad emotional decisions. I'm going to take a short break. Visit our website, ReznyWealth.com. Download any of our free reports. Also check out our workshop tab. We have ongoing workshops around Florida if you want to learn more about investing. If you don't want to make bad mistakes or emotional decisions, go to ReznyWealth.com. You can also sign up for a consultation there. I'll be right back after this. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. And we're back. Hopefully you're enjoying today's program. Of course, if you have a question, email that to me at brianrezny@ReznyWealth.com. Also, visit our website, ReznyWealth.com. Again, you can sign up for upcoming workshops. You can learn more about retirement planning. You can download any of our free reports. One of our reports, Why Annuities Are Dangerous to Your Wealth and Retirement, is groundbreaking. You'll learn what the annuity salesman doesn't want you to know, and by taking your money and putting it into an annuity, you can cause yourself more long-term risk than you realize. Doug in Miami, Florida. I am 61 and will be retired in 2018. My 403B is invested in 90% equities, mostly U.S. My financial advisor suggested I go with an allocation of 45 equities, 55 bonds. I want to grow my portfolio. What are your thoughts? First off, Doug, is your advisor a real advisor? Are they a fee-only money management RIA or registered investment advisor? That would be my number one question. If they're not, don't take any direction from that person, because clearly they could just be trying to sell you other investments their firms recommend. Now, you're going to retire in a few years. Your goal is to grow your money. Do you need income from this portfolio? If you are 90% allocated to the U.S., which sectors of the U.S.? There's varying sectors of the U.S. Also, I would tell you this, do not only look at the U.S., look at all other asset categories around the world, because there are times you may want to own, as an example, emerging markets, or you may want to own precious metals in your portfolio. Bonds and equities are not the only two asset classes out there. There are other asset classes that may make a lot of sense. What I will tell you is this: by moving your money from a 90% allocation of equities down to 45 and then 55 in bonds, to me is a huge mistake. Too many retirees do not understand how bonds truly work. Now, brokers like to sell bonds because people get an interest payment. The problem is, under current interest rate environments, if rates only stay stable, meaning they don't even go up, you're going to make dismal rates of return under inflation and taxes the next decade or two. Your retirement's not going to survive. Investors today need to have a higher allocation to equities. If you're going to do that, I would stay more on the large cap side, higher dividend payers. I would utilize only ETFs or exchange traded funds because of their low cost and no shenanigans of Wall Street mutual funds and such. Look at large cap. Dividend and growth potential brings you total return. That gives you the opportunity to get a higher overall long-term return over the next 3, 5, and 10 years. Bonds are not going to cut it. Bonds are only a short-term buffer. I would not have more, even if you're a more conservative investor today, I would not have more than 30 to 40% in bonds. And if you do, they should be very short-term, under 2 years. Rates are too low. And again, if rates stay stable, you're not going to make much. If rates slowly move up, you could lose a lot of principal value on bonds if you over-allocate. Steve from Bokeelia, Florida. First, your show is excellent. Thanks, Steve. I wish I would have listened to your straightforward advice 4 years ago. I've been holding 60% cash for the last 4 years. I've been trying to buy on a dip, and I'm paralyzed to make a move. This has hurt my portfolio returns. What would you do now? Steve, I had a similar question earlier in the show. When you're paralyzed, when you can't make a decision, hire a firm. You need to hire a real fee-only money management firm. Call my office. We'd love to sit down with you. We can show you how we can better your retirement, how we can build a quality portfolio and keep you on track. People who are paralyzed and you're not making that move, again, you're not going to make the next move when you need to get in, and you're not going to make the next move after that when you ultimately need to get out. Obviously, being in cash that long has severely hurt your returns. You need to follow a strategy. That strategy has to have discipline, and sometimes even when it's a little uncomfortable, you still need to invest in order to make those short and long-term returns your portfolio and your retirement are going to need. Sam in Fort Myers, Florida. What are your thoughts on oil stocks? I own XOP, BP, and Halliburton as 17% of my portfolio. First off, Sam, you have an overconcentration into 3 individual equities, which I think is a big mistake. If you're going to look at oil, unless you're an expert and you are spending 10 hours a week researching those 3 stocks and you really understand those stocks, and I'm not talking about looking at your computer screen or pulling up your brokerage account, looking at the price change. I'm talking about hardcore research. Most individuals aren't able to do that properly because they just don't have the knowledge. If you like oil, what I would look at is the Spider XLE. It's an ETF. It owns a broad basket of oil service stocks and oil integrated stocks. I think it's a better bet than the 3 stocks you own. More diversification, less volatility. You still have the chance for the dividend, but you have the real chance for ultimately growing that portfolio because you're not just in 3 stocks that may plummet at any one time. You're in a large pooled basket. ETFs are an excellent tool for expert investors to use and even novice investors. It gives you the diversification you need without the whipsaw of individual stocks and all the time and research it's going to require you on an ongoing basis to do. Chris from Chicago, Illinois. What are your thoughts about annuities? I am 67, 500K, 27,000 a year yearly income. Good question. You're talking about annuitizing an annuity. First off, Chris, I'm going to say this to you. You're 67, you have 500,000 in an annuity. And you're going to annuitize this and you're telling me you're going to get 27,000 a year. Do the math. Take 27,000, divide it between 500,000. It's going to take you almost 20 years, 20, to get your own money back. So you're 67. In 20 years, you're going to be what? 87. And you've gotten your own money back. If you live longer, they'll keep paying you that 27,000. But the problem is you have no inflation protection and no growth. $27,000 a year today sounds good. In 10 years, at just 3% inflation, you can subtract 30% off that $27,000 in purchasing power. Meaning, you're getting, let's say, $18,000. Can you afford a 30% haircut in your pay in the next 10 years? But remember, you got a decreasing pay schedule every single year as inflation continues. Annuitizing annuities is a huge mistake. I would suggest you go to my website, reznywealth.com, download for free Why Annuities Are Dangerous to Your Wealth and Retirement. It talks about why you don't want to annuitize annuity, why annuities have crazy high costs that rob your return, why the people that sell annuities don't work in your legal best interest, why there's no free money bonuses, and a whole lot more. If you've ever been sold an annuity or somebody's trying to pitch you an annuity now, that groundbreaking report, in my opinion, will help save you from a disastrous decision. Never invest in an annuity, and annuitizing an annuity at the interest rates we have today with inflation over the next 20, 30 years would be a disaster for your retirement. Eric in Boca Raton, Florida. I own GDX and GLD for about 15% of my portfolio. I'm nervous about asset protection against inflation and our government. What are your thoughts about gold? First off, I will tell you this, Eric, never own relatively weak assets in a downtrend. Both the GDX, which is an ETF that buys gold miners, and the GLD, which is an ETF that owns physical gold, are both in a downtrend. They've been in a downtrend for over 3 years. If you look at last year, gold was down over 30%. If you look at this year, it's down another 3 or 4%. Gold miners were down 50 and 60%, with another 10 or 15% downward this year. You do not want to own assets relatively weak. But investors, for some reason, think just because an asset's down, it can't go down further. What you want to do is look at this. If the daily price is under the 200-day moving average, which clearly GDX and GLD are, don't own them. What you want to do when you know there's a potential bottom, when you get a bottom in the price, it comes up a little bit and reverses after a long downward spiral. And then if it holds that bottom price and it starts to reverse back up for that second time, you then have an opportunity, once it's above its 35-day moving average, to add to a position. But don't own gold now, and I would not own GDX either. The government's not going to take your money, and we don't have rampant inflation. And also we have tax year selling at the year end that usually pushes down assets that are down year to date even further. You may get a little bounce back at the beginning of 2015. We don't own gold or GDX, and I wouldn't own it in the near future either. Gary from Arizona, commodities and energy, what are your thoughts? Again, like my last caller, first off, commodities have been relatively weak for over 3 years. I wouldn't own them. In fact, if I look at our market trend indicators at Rezny Wealth Management, they're negative. Don't own commodity-based assets, and energy is part of that. It's in a downtrend. Energy obviously is negative year to date. As we get into year end with tax law selling, it'll probably drive down energy some more. I would look for that double bottom, and then again, if it reverses and the daily price is above the 35-day exponential moving average, it may be a great time to add back to energy, but I wouldn't own energy right now into year end. Folks, I am just about out of time. Visit my website. Make sure you download any of our free reports, check out our workshops, and so on. You deserve great financial advice and excellent service. Find out if you're on track. Schedule a financial and portfolio review so you can understand how to improve your portfolio growth, how to increase your retirement income, and reduce investment risk, and get answers to your important financial questions. At Rezny Wealth Management, we're a fee-only money management providing exactly what you need: timely advice and management of your assets. Please call us for a consultation and visit our website, reznywealth.com. Make sure you have yourself a safe and profitable week.